an assistant professor of economics. She'll be discussing her work, as the slide shows, on adaptation and adverse selection in markets for natural disaster insurance, with particular reference to the flood insurance program in the US. I don't want to spoil the big reveal, but what she's going to tell you is that she's got some powerful lessons about how when you combine information asymmetries and behavioral frictions and frailties, you can get crazy results that just defy any simple economic logic, but that, on close examination make great sense. So that's like a 1-second summary of a lot of hard work that she did to produce the paper that she's going to be talking about, which appeared last year in the American Economic Journal, Economic Policy. Before I ask you to join me in welcoming her, 2 quick announcements. The first is that our next talk 2 weeks from today is going to be Tom Baker and Anya Shortland talking about the symbiotic relationship between insurance and crime. And the other is just that, as usual, if you have a question, please feel free to raise your WebEx hand, that little icon down on the bottom, or send me a chat. And with that, Katherine, the virtual floor is non-virtually yours. Take it away. Thanks.
Great. Thanks so much for inviting me to come and present my work. I'm really excited to hear all of your comments. Can you hear me? We're good? All right. As I was saying, really excited to be here and looking forward to hearing your thoughts.
Where did you go? We can't hear you. At least I can't. Can everybody else hear? Okay, that's my problem then. Sorry. Keep going. Sorry.
No worries. I will once again express my enthusiasm for being here. You didn't miss anything on that front. So yeah, as was mentioned, I'm presenting work today on adaptation and adverse selection in natural disaster insurance markets. I'm told I have about 35-40 minutes, and then hopefully we'll be able to have a lively discussion at the end. So this project is really motivated by the rising costs of natural disasters around the world. So in 2017, around when I started this project, natural disaster damages around the world cost $300 billion. And unfortunately, this number isn't an outlier anymore. These natural disasters such as hurricanes, wildfires, extreme heat continue to cause billions of dollars of damage every year. The images here, first one on the left shows one house that survived the Hurricane Michael that hit Florida in a few years ago. And the image on the right, which is near and dear to my heart, shows the view from my apartment in Berkeley, also a couple of years ago during the really severe wildfire season that they had then. So both of these disasters are representative of this rising trend in natural disaster damages around the world, which I'm now showing you here on this slide. This shows the increasing natural disaster costs over roughly the last 4 decades. And we can see that insurance plays a large part here. The insured damages are shown in blue, but there's potentially a lot more exposure, and the costs that are going to be borne by insurers may conceivably continue to rise as costs do. And so this leads me then to the 3 research questions that I'll try to shed some light on today. And these are intended to address gaps in the literature which are needed to inform policies that will allow homeowners to adapt to these rising costs. The first of these questions is just simply how much are homeowners willing to pay for natural disaster insurance? And the second is how does willingness to pay affect the cost of providing insurance to homeowners? So in adversely selected markets, willingness to pay and cost are going to be correlated. Homeowners that have a higher willingness to pay for insurance are going to be more costly to insure. And this is going to be really important for thinking about the outcomes of pricing policies, right? So one of the main ways that the government in the US has chosen to regulate natural disaster insurance is through this price lever. And then finally, given that we're thinking about price reforms in natural disaster insurance in the US, I'm going to explore some of the welfare consequences of these policy reforms that are currently proposed. Motivation for this project: these are policies that the government is actually thinking about. We've started to move towards actuarially fair flood insurance pricing in the US with a new set of reforms called Risk Rating 2.0, which is intended to incorporate more updated measures of risk into flood insurance prices. Government is also thinking about flood insurance mandates. One of these actually exists if you have a federally backed mortgage in high-risk flood zones. And there's some question about whether or not this is actually enforced. Historically, it seems not to have been so. The second main motivation here is that these estimates of willingness to pay and the cost of providing insurance to homeowners are needed to evaluate the welfare effects of some of these proposed policies. So I'm going to try to put some numbers on these things in order to make statements about welfare. And then finally, it isn't clear that the existing literature, which is focused very much on other insurance types like health, unemployment, until quite recently, it isn't clear that the conclusions from those markets generalize very well to natural disaster insurance, which is characterized by really large shocks, highly correlated risk. And so we're going to think about whether some of the findings of adverse selection and so on, which hold in other markets, also hold here. And I'm hoping we can have a conversation about this at the end. So what I'm going to do here, first, I'm going to, at a very high level, develop a model of natural disaster insurance markets, which is going to provide a framework for thinking about how some of these market failures might arise. I'm going to take this framework to an extensive data set on natural disaster insurance policies and housing in the US, focusing, as I mentioned, on flood insurance. And then finally, I'm going to exploit house-level variation in prices and construction codes in high-risk flood zones in the US in order to estimate some of the model parameters and test for adverse selection in this market. So why might we be concerned about market failures here? There are three main ways in which government intervention could potentially improve outcomes here. So first potential market failure are frictions in take-up. And this is a question of whether or not people buy insurance in the first place. In the natural disaster setting, we could potentially think about a lot of potential distortions. Homeowners may underestimate their natural disaster risk. This isn't something they experience very often, and so they may have trouble conceiving of some of the probabilities in this setting. They may not know, for instance, that flood insurance is excluded from a standard homeowners policy. There may be some inattention to the details of their homeowners policy as well, or they could be inertial. They didn't buy flood insurance before. Climate risk continues to change. They don't buy it afterwards. The second market failure is adverse selection. And this is a question of who actually does purchase insurance. If willingness to pay and cost are correlated, then there's maybe potential for selection in this market. And selection could arise on unobservable or observable determinants of natural disaster risk. So selection on unobservable determinants of risk would arise if homeowners have more information about their insurance risk than the government does. And if they take these private determinants of risk, such as features of local hydrology, you know that the sewer near your house tends to back up and flood your basement quite often, you may be more likely to purchase insurance, and the government may not know that you're higher risk. We could also have selection on observable determinants of risk, and these are things like adaptation. So the extent to which you elevate your house could influence both your risk and your decision to purchase insurance. And then whether or not this risk is completely priced in to your flood insurance contract will determine whether or not there is unpriced selection here as well. The third market failure is moral hazard. And this is a question of whether or not insurance changes behavior. Do you undertake different residential housing investments, like elevating your house, when you do or do not have flood insurance? Insurance could also potentially distort which house you buy and where you live. So in this paper, I'm going to focus the analysis on the first two of these points, and I'm going to leave the third point for future research, but I will make a point of talking about how it changes the conclusions of the first two parts of the paper. So what do I find? So first, frictions and take-up in this market seem to be quite important. So I'm finding that over 40% of homeowners in high-risk flood zones are uninsured, even though they're getting a subsidy that pushes the price of insurance below their expected cost to the insurer, below the expected benefit that they would obtain if they purchased the contract. So standard models of rational homeowner behavior predict that homeowners should be willing to pay their expected cost plus a risk premium. And I'm finding here that homeowners aren't even willing to pay their expected cost. Over 40% of them are uninsured. And I'm going to devote a good chunk of today's presentation to exploring alternative explanations for why this is. But it seems as though standard explanations in other insurance markets, such as moral hazard, adverse selection, public bailouts after floods, these explanations appear unable to explain the extent of uninsurance here. And so I am going to find that risk misperception in this market seems to play quite an important role. The second part of the paper, when I turn to talk about selection, I'm going to find no evidence of adverse selection on unobservables. So homeowners don't seem to have private information about their risk that's leading them to change their behavior and purchase insurance or not in a way that also changes insurance costs. But I find evidence of adverse selection on observables. So homes that are required to be elevated are about 25% less likely to purchase insurance and about 1/3 less costly to insure. So this is going to be adverse selection on adaptation. And we can think of, the private, no selection on unobservables or private information perhaps makes sense here when we think that this is a market where the government could potentially observe a lot more about your risk than a market for health insurance, say, where there's potentially extra room for you to know things about your family history and so on that the insurer might not. So what does all of this mean for social welfare then? If we ignore the potential for frictions in take-up to distort homeowner behavior, we're going to understate the welfare loss from actuarially fair pricing. So in standard models, adverse selection leads to potentially too little insurance in the market and prices rise. And what I'm going to find here is that if we ignore the possibility for frictions to distort demand, we're ignoring the fact that making flood insurance actuarially fair would actually push people out of the market even further. All right, so without frictions, we would want to make flood insurance actuarially fair to correct for the distortion from adverse selection. Here, the welfare effect is going to push in the opposite direction, because if we raise prices, a whole bunch of people are going to cease to purchase insurance when they would actually benefit from it in expectation. So the welfare effect is going to change sign. By contrast, I'm going to find that enforcing a mandate increases social welfare because all of the people who are underestimating the benefit of insurance are now going to purchase it, and then they would benefit from insurance in expectation. So I'll get into a little bit more of the mechanisms here in a few slides. Before I go on, let me just pause and see if there are any questions about where we're going. We're good? Put a thumbs up. Okay, so this paper is going to make 4 primary contributions to existing literature. So the first is the literature on frictions and take-up of insurance and other social benefits, which has largely focused on other markets for other insurance products, such as health, unemployment, and so on. So this paper is going to provide new estimates of homeowners' willingness to pay for natural disaster insurance and identify this kind of weird wedge where willingness to pay is going to be below homeowners' expected benefit from insurance, the marginal cost of providing insurance to them. The second related literature is on selection in insurance markets, and here there's a very extensive literature focusing again on these more commonly studied insurance markets such as health. So this paper is going to provide the first test or evidence of adverse selection into any natural disaster insurance market and the first instrumental variables estimate of the price elasticity of demand for natural disaster insurance. And the third related literature is on climate change adaptation. And in the case of building codes, there started to be more work in this area before, but this is the first paper to estimate an adaptation elasticity. So the extent to which demand for insurance substitutes or complements other types of climate change adaptation. In this case, I'm going to be talking about house elevation. And then finally, I'm going to present a new method to derive homeowners' willingness to pay for natural disaster insurance by inverting other methods that have been applied to other markets and bring this into the natural disaster insurance context. Importantly, this isn't going to require me to take a stand on what the distribution of frictions or misinformation looks like, or what the distribution of risk aversion looks like in the population. And I'll just sketch this out a little bit at the end. Okay, so 25 or so minutes remaining to me. I'll provide a little bit more context about the National Flood Insurance Program. Then I'm going to try to provide some of the intuition for how frictions and take-up in this market change the welfare implications of proposed policies. And then I'll present some data and results from testing for adverse selection here, talk about welfare briefly, and then I hope we'll be able to have a lively discussion. And if anything is unclear, you should feel free to, raise your hand and so on throughout. I'm coming from an economics background, and so I'm used to lots of questions throughout the talk, and you shouldn't be shy if anything is unclear. Okay, so the National Flood Insurance Program has received a fair amount of attention lately since it's the primary provider of flood insurance in the US. It's a public program, and it bears essentially all risk of flooding throughout the country. So they're writing flood insurance for almost all houses. The private market in this setting is quite small, which makes it really nice to zoom in on some of the distortions on the demand side of natural disaster insurance, since flood insurance contracts are basically perfectly elastically supplied by the government. So they're pretty important sums of money at play, right? The government is collecting over $1 trillion of annual, over $3 billion of annual premium revenue for about $1.25 trillion of coverage for flood insurance throughout the country. But despite this, they're over $20 billion in debt because of large natural disasters that have happened in the past and kind of wiped out any reserves that they might have had. The prices for flood insurance are set based on a limited number of house characteristics and flood zone. And this is what's going to create the possibility for adverse selection here. The government isn't actually pricing very many things. And so it's conceivable that you as a private homeowner might know more about your risk in these places and would be able to act upon this risk, change your demand for flood insurance in a way that would increase costs to the government. So I'm going to exploit price changes that affected only some houses to be able to see first, when we change prices, how does demand respond? That'll help us get a handle on what willingness to pay is here. And then also when we change prices, how do costs respond? This is going to allow us to assess the extent to which these markets are adversely selected. So the price changes that I'm going to use are based on the fact that houses that are built before or after these flood maps were drawn in the US faced different prices after 2013. So beginning in 2013, prices started going up for houses that were built before these maps came into effect. These houses were ones that didn't have any minimum construction code standards for their foundation, and which therefore were receiving large subsidies. These ones are riskier. And so we started phasing out their price changes beginning in 2013. These are the price changes that I'm going to use to try to identify some of the slopes of the demand and average cost curves. Now, just to be clear here, when I talk about adaptation, these differences in house elevation can be pretty salient, right? So here I'm showing you a set of 3 houses in the Bolivar Peninsula in Texas. It's easy to imagine here if these palm trees had been a little more robust, these houses could have complied with the government's minimum elevation standards simply by building tree houses, right? And so the salient differences in elevation create salient differences in risk that maybe these more subtle differences, like the extent to which the local sewer was back up and so on, don't matter as much for homeowners' decisions. We'll come back to this. All right, so I'm going to ask you to bear with me while I show you a few Greek letters, and then it's only one slide. We're going to walk through the intuition in the graph. So the model, which is more involved in the paper, has a homeowner deciding whether or not to purchase insurance. So this is an extensive margin purchase choice. They're going to also differ in their extent of adaptation. So some houses are going to be required to meet minimum elevation standards for their foundation. And I'm going to refer to these as adapted houses. There's also potentially going to be some level of frictions in take-up in the market. These frictions in take-up are going to be things like misperception of risk, inattention, inertia, potentially others which haven't been explored in existing literature. And then each homeowner is going to have an underlying type which determines their willingness to pay for insurance. These are going to be things like how risky the area is where they live. What are their risk preferences? What are their risk premia in this context? Anything else which might affect your decision to purchase insurance, but which the government doesn't observe or price. So it's quite general. And then each house is going to have some potential level of flood damage, which is going to depend both on this underlying type and on the extent to which they're an adapted house. So we're going to take all of these pieces into this graph. And we don't need to bother too much with all of the Greek letters here, but what I want you to take away are these three different curves. So there's one curve, which I've denoted here as the observed willingness to pay curve. This is basically demand for insurance. As we move right on the x-axis, the share of insured individuals in the market goes up, and the last individuals to purchase insurance have the lowest willingness to pay. This is what downward sloping willingness to pay means. Then we have the marginal cost curve. The marginal cost curve measures the cost to the insurer of the last individual to purchase insurance. The downward slope here means that the market is adversely selected. There's a positive correlation between marginal cost and willingness to pay. In other words, the last individual to purchase insurance is less costly to insure than all the ones that have come before. The average cost curve then is the average over everybody who purchases insurance. And so since we continue to add less costly individuals to the market as we move right along the x-axis, the lowest willingness to pay people have the lowest marginal cost. And so when we add one more person to the market, this drags the average down. So the average cost curve also slopes downwards in this space. Now, the way that I've drawn it here, this is the standard setup where observed willingness to pay accurately reflects individuals' willingness to pay for insurance. If observed willingness to pay is sort of based on rational consumers' behavior, then we can find the efficient number of people to insure based on the intersection between the demand and marginal cost curves, right? It's efficient to insure people up to the point where the benefit they get from insurance is exactly equal to the cost. If we were to continue to insure individuals to the right of this, these people are more costly to insure than the benefit they obtain from insurance, right? So in this setting, we would conclude that prices should in fact be relatively high because observed willingness to pay is quite low. Now, the issue arises if What's this point here? This is the efficient point. The issue with this conclusion, with raising prices to obtain this efficient level of coverage, is if observed willingness to pay doesn't actually reflect individuals' willingness to pay for insurance. If homeowners misperceive their risk, their true benefit from insurance could actually be quite a bit larger. They just aren't internalizing that. And so there's a true or frictionless willingness to pay curve, which is somewhere above the observed one. If homeowners accurately knew what their risk was, they would be willing to pay more for it. And so now, in this case, the efficient allocation, the efficient price and share of insured folks, is actually much lower, has a lower price and a higher share of insured folks than what we would conclude in the previous situation. And so if we're starting from an equilibrium where 60% of the market is insured, that's what I'm going to find, and we find, as I do, that willingness to pay is below cost, and we sit back and we say, okay, people aren't willing to pay very much for insurance, we should just uninsure these folks. This would suggest we should actually raise prices. And we would obtain, in doing so, a welfare gain equal to this beige area. But actually, if homeowners would actually get more benefit from insurance than their willingness to pay suggests, because they aren't incorporating true probabilities into their calculus, for example, then if we raise prices, we're going to uninsure a bunch of people who would actually benefit from insurance and expectation. And for these folks, their willingness to pay is actually above the marginal cost of providing insurance to them. And so we're going to arrive at the opposite conclusion. All right, if we're operating under the assumption that observed willingness to pay reflects full information about your benefit from insurance, we would want to raise prices. But if homeowners would actually benefit more from insurance and expectation, we're going to arrive at the opposite conclusion. And so in order to figure out what these welfare areas actually look like and evaluate proposed price increases in this market, we need to know what these curves look like and where frictionless willingness to pay is relative to marginal cost. And so I'm going to get there by estimating 4 parameters. I'm first going to estimate the observed demand and average cost curves. And I'm going to do this using the congressional price reforms that I just told you about, that raise prices for one group of houses but not others. And then, in order to figure out what homeowners would pay for insurance if they accurately perceived the risk, I need to know coefficient of absolute risk aversion, so how risk averse they are, and the effect of natural disaster insurance on the variance of consumption. And I'm going to calibrate those 3rd and 4th parameters based on the literature and observed payouts. So just to give you a sense of what I'm going to do, I'm going to first estimate observed demand and average cost, which is going to allow me to derive an expression for the marginal cost curve. That's individuals' expected benefit from insurance. And then once I know the marginal cost curve, I can add on the risk premium to obtain the frictionless willingness to pay curve. And I'm going to do this using the marginal cost curve and the coefficient of absolute risk aversion, the effect of insurance on the variance of consumption. So these 4 parameters are sufficient statistics for welfare analysis. With these 4 parameters, I can make statements about welfare without needing to know the distribution of, say, these frictions in the market and what exactly gives rise to individuals' low willingness to pay for insurance. So that's where we're going. What data am I going to use? So this is data that I obtained through 5 Freedom of Information Act requests from the US government. So this is the universe of national flood insurance policies and claims for 20 Atlantic and Gulf Coast states over 17 years. So I'm showing the states included in the analysis below. And this is over 70 million observations for over 80% of the market. For those who are interested, there's been a more recent data release by the Federal Emergency Management Agency that actually makes quite a bit of this data public. So that's a great resource for anybody who would like to work in this area. I'm happy to chat more about that. I'm also going to use the universe of residential houses in these states, and I'm going to merge each house in each of these states with spatial data on flood zones. So I'll be able to identify at a very fine level which house is in a high-risk flood zone and which house is in a low-risk flood zone. Okay, so then this puzzling fact that I find, which then motivates much of the rest of the paper, is first, there's a huge subsidy to flood insurance in high-risk flood zones. So homeowners are paying, on average, $4.38 for $1,000 of insurance coverage during this time period, and they're getting back about $6.23 for $1,000 of insurance coverage. So on average, this is a 30% subsidy. Pretty substantial. So we look at this, and then we have to ask, well, given this subsidy, why are only 58% of households insured? So even though this average subsidy exists, take-up rates are below 60%. And there's several possible reasons for this. And the first of these is adverse selection. All right, so this is a subsidy based on average costs. But if you're the last homeowner to purchase insurance and your own cost is well below average, as would be true for all of the uninsured folks in this market, if those folks have costs less than average, then it may not be worthwhile for them to purchase insurance, even with this huge subsidy. So I'm going to start by exploring the extent to which this is true, and then I'll discuss several other explanations before we move to our group discussion. So in order to test for adverse selection, as I said, I need to know the slope of the marginal cost curve. This was the downward sloping curve that I showed you in the graph before. And the intuition for this is that if prices rise, average costs rise, this means the lowest cost individuals had a lower willingness to pay and they opt out of insurance when prices rise. So I'm basically going to test how average costs change when prices change. I'm also going to see how demand responds, because of course, if there's adverse selection, there needs to actually be selection. There needs to be some kind of demand response demand response when prices change as well. So I'm going to start by looking at demand and cost, and I'm also going to look at the other piece that I mentioned, selection on observables. So I'm going to see how house elevation affects individuals' propensity to purchase insurance as well. All right, so the first thing we want to ask or check is whether prices actually responded to the policy that I described. So this policy changed flood insurance prices for houses that were built before these flood maps came into effect, which were not required to be elevated. We can see here measured relative, the adapted houses, so houses that were built afterwards, face relatively lower prices after this policy change comes into effect. Remember, the prices for the other group are going up, so the elevated houses built after communities are mapped face relatively lower prices. So this gives us some confidence that if we see demand and cost responses after this point, we can attribute these changes to this price change that I'm showing here. So first, I'm going to see if demand actually does respond to prices as a prerequisite for adverse selection, and I find that it does. So this graph now shows relative demand for these houses that are required to be elevated compared with the ones that are not required to be elevated. So the prices are going down, relatively speaking, for this group. We can see that demand increases. And this means that we do, in fact, have a change in the demand for flood insurance. And now we want to see if those people who change their demand have different costs than the people who we do not. Now, one challenge with looking at time series variation in prices on average costs is that this is a market with very infrequent observations or realizations of risk, right? So in some years, you get a Hurricane Katrina, and in some years, there's relatively little flooding. And so I'm going to break down the effect of prices into different flood bins. Okay, so bear with me here. In this graph, I'm showing you the base level difference between costs for houses that are and are not required to be elevated. There are 6 monotonically increasing floodwater depth bins. Now, if there's no flood, costs between houses that are and are not required to be elevated mechanically equal to 0, right? There's no flood, no costs, 0 difference. We see that elevation really matters in the most severe floods. And this is this adaptation elasticity that I mentioned. Now the question is, does this relationship between adaptation and cost change when we also change prices? And so I'm going to see if after the price change, this distance changes with any level of significance, and the answer is no. So these red coefficients are giving you the price effect, small in magnitude, statistically indistinguishable from 0 here. And so this suggests there's no response of average cost to prices. We don't have this downward sloping relationship that I showed you in the graph. And so there's no adverse selection on private information here. You can check the effect of elevation now on demand and costs. So this graph is now showing you the change in demand for houses that are and are not required to be elevated. You can see that for houses that are required to be elevated, these are the ones that are built after these maps come into effect, demand drops substantially. Okay, so there's the potential for selection on this observable if this observable also affects costs. So that's what I'm going to test for next. And it turns out it also affects costs. So this graph is showing you the change in costs when we switch from houses that are not required to be elevated to houses that are. Costs also fall. All right, and so this means that there's adverse selection on this observable, this adaptation policy that requires houses to be elevated. Houses that are required to be elevated are both less likely to purchase insurance and less costly to insure. So overall, what are the takeaways from these graphs that I just showed you? First, there's strong evidence of adverse selection on observable house characteristics, right? This is the result that these elevated houses are both less costly to insure and less likely to be insured. But there's no evidence of adverse selection on unobservables in this market. There was no response of average prices to the change in prices, sorry. And so this means, relative to the graph that I showed you, average and marginal costs are equal, conditional on being an adapted house. And since they're equal, this difference in marginal and average costs cannot explain the extent of uninsurance in this market. Not only do we have 40% uninsurance with a 30% subsidy below average costs, we have 40% uninsurance with a 30% subsidy below your own expected costs. And this is what goes against sort of standard economic theory here, right? Because in the absence of any frictions, homeowners should be willing to pay at least their own cost for insurance plus a risk premium if they're risk averse. And so in the paper, then I spend a fair bit of time discussing these other explanations for why willingness to pay might be quite low. Since I'm getting close to 40 minutes here, I might conclude and then leave this slide up, and then I'm happy to talk about which of these individual explanations might also play a role here. The one that I will highlight is risk misperception, because it seems to play an important role in explaining why homeowners aren't willing to pay even their own marginal costs for insurance. So surveys suggest that homeowners really don't seem to have a good handle on what their flood risk probabilities are, and that they underestimate these probabilities relative to both the government's model and independent storm surge assessment, so private risk models. And so this suggests that we want to be quite cautious about using the willingness to pay that we observe to evaluate welfare, because it suggests that it leaves out some of the true benefit of insurance to homeowners. So then to conclude here, overall, I find that homeowners' willingness to pay for insurance is significantly below their own expected benefit from insurance, which suggests that there seems to be some role to play for frictions in this particular market. Second, unlike more commonly studied insurance markets such as health, there's no evidence of adverse selection on private information in this setting. So homeowners seem to have less private information about their flood risk than they do, say, about their health risk. However, adverse selection on adaptation is important. And one possible reason for this is that these adaptation policies provide really salient signals about risk. Remember, I showed you the houses that were 3 stories up off the ground. This is a very clear signal that your house is potentially safer. And third, mispricing in this setting is particularly complex and contentious. So implementing some of these price changes has to take into account potential frictions in take-up, adverse selection on observables, affordability concerns in some of these local areas, and potentially political constraints. And yet, if we go about using some of the policy tools that we've tried to employ before, really imposing actuarially fair prices, we have the potential to create a large welfare loss by uninsuring folks who would actually benefit from insurance and expectation. And so this perhaps should lead us to think about enforcing some of these take-up mandates or thinking about other policies to encourage adaptation. But discussing all of these issues, I think, is going to continue to be important simply because of the magnitude of what's at stake. If we look at the last 100 years, over 75% of costs from hurricanes have occurred in the last 2 decades. And so if this trend continues, we want to think carefully about how to design some of these markets to shield homeowners from some of the costs associated with increasingly severe natural disasters. So thank you very much. I'm going to flip back to my slide with all of the different possible explanations, and then I'm happy to field any questions you might have.
Great, thank you very much. I have a million questions, but let me turn to the queue, which consists of Ken Klein first and Andrea Martin, and then if anybody else wants to chat to me. I can't see everyone's hand given that the screen is, oh, there's Omri. Okay, so we have Ken, we have Andrea and Omri, and then I'll, if you want to chat to me, that's better than raising your hand given that there's a slide up. I can't see everybody.
I'm also happy to stop sharing if that's easier.
It doesn't matter, fine. So anyway, Ken, you're up first.
Thank you, and thank you for that very interesting presentation. I had basically 2 questions. The first is, there was work by 2 economists, Collier and Reagan, on national flood insurance that produced a data set that suggested once a consumer made the decision, in this case, involuntarily typically, that they were going to have flood insurance, that they were not price sensitive, that given the choice to underinsure, insure to the number, or overinsure, 80% would fully insure or overinsure. And so my first question was, does any of your data contradict that finding? And then my second question is as to take-up rates, which are that at least the latest data I saw was that take-up rates, voluntary take-up rates for people who had a choice on flood were about 10%, slightly below. And that voluntary take-up rates for earthquake also in California was right about 10% and nationally right about 8%, and that you'd get to similar numbers if you looked at renters insurance when it was voluntary. And so my question is your data suggesting that there is anything different about take-up rates for flood as for any other kind of essentially P&C insurance by a voluntary insured?
Let me start by answering the second question. So the 60% or roughly 60% number is for high-risk flood zones in the US. If you go nationally and include all of the low-risk flood zones, the take-up rates go way down. Some of the numbers I've seen for low-risk flood zones are closer to that 10%, right? So the people do seem to have some sense of their risk. There's more information about flooding in these high-risk flood zones. Makes sense that take-up rates are perhaps a bit higher there. For encouraging take-up, so homeowners are supposed to or required to purchase flood insurance if they have a federally backed mortgage. Historically, this has been very patchily enforced. I think they're starting to tighten the screws on it now just because there's been so much attention on this market. But this is one way to potentially get those take-up rates even higher. Earthquake insurance is interesting. So I lived in California for 2 years, San Francisco Bay Area. I now live in Vancouver, which is, also haven't really changed risk that much for earthquakes. And just anecdotally talking to people, there's some concern that if you purchase earthquake insurance and there is the big one that wipes out San Francisco, there isn't an earthquake insurer in the world who's going to be able to remain solvent and actually pay out those claims. And I don't know that reinsurance markets have advanced sufficiently to address that, but certainly people themselves seem concerned about the financial solvency of folks who would have to cover those costs. And since flood insurance is publicly provided, in some ways there's sort of unlimited, so far there's been unlimited backstop by the Treasury for paying out some of those claims in the flood insurance market. So that's one way in which it is different. For the paper you mentioned related to your first point, I'm not familiar with this paper off the top of my head, but the way that you talk about it makes me think that it's intensive margin coverage. So they're looking at, once you buy a policy, do you buy more or less insurance, conditional on purchase? And that does seem to be pretty inelastic. So I didn't talk about those results here just because there isn't really that much to say. If you don't have any kind of demand response on the intensive margin, then you can't have selection on the intensive margin. And so the papers that have looked at the extensive margin haven't quite been able to use policy variation that would allow you to identify a demand curve. And so that's a distinction of my work relative to other papers on the extensive margin, but my intensive margin results would be consistent with the paper you described. Thank you.
Cool. All right, Andrea, and then Omri.
Hello, thanks for being here with us today. I was thinking, after reading your paper, I was thinking a lot about the adverse selection and on the observable characteristics and how there's a lot of pricing inefficiencies with flood insurance and the NFIP, like tracking real time how the flood zones are changing. And I guess this goes a little bit beyond the economic like calculation specifics that you were talking about in the presentation. But I was just wondering if you had any opinions or ideas about what kind of alternatives might exist to their pricing structure. So like what kind of monitoring ideas you have about how they could do a better job of effectively pricing things and just keeping track of the areas that are changing.
Yeah, so I guess the first piece of that is making sure that the models that they're using actually reflect underlying flood risk. I think there's a big push right now to modernize the flood insurance maps that delineate areas at high and low risk of flooding. But for a long time, there were a number of houses that were just misclassified, and flood risk has changed, and so those misclassifications have been exacerbated. And so just bringing existing flood models up to date with the latest science, I think will get us a long way towards figuring out what the prices should actually be. And then once we're there, then we can talk about what other complementary policies we might like to have, whether that's, having a flood wall so that you don't need to purchase insurance as much, or having some kind of information campaign to make sure that people actually know what their risk is and then can make an informed decision about whether or not they want to purchase insurance. So far, really, I mean, this paper focuses a lot on prices just because that's the lever that the government has really pulled thus far. Thanks for your question.
Omri Ben-Shahar.
Hi. Well, thank you. I didn't read the paper, but I really enjoyed your presentation. And
Thank you.
I don't really have anything to say about the mechanics of the model, and I've learned a lot by listening to you. But I want to latch on to something that you said at the opening, and maybe is kind of appears here on the last slide about the policy implications. And one of the things that I take you, maybe I didn't understand exactly, but I take you to have said is that programs aimed at raising the prices and making them more actuarially fair, you think we should be cautious about them. They might backfire because you think that they might harm even more the take-up rates. Although after listening to Ken Klein and thinking maybe all what we're seeing in terms of take-up rates is the mandated take-up rather than the voluntary one, that seems quite conjectural. But even if that were the case, I would still be a little bit anxious about stressing that implication, because I see other value that occurs to the in the inframarginal portions of the market to having actuarially fair flood insurance premiums. One, it has to do with activity levels, namely the decisions of people to move into flood zones or to rebuild after destruction in the Florida Keys, for example. Those decisions, you know, people, the 60% who are insured should make better decisions. And then second, and this is something in my work with Kai Logue we've shown, the regressive cross-subsidy that occurs in these markets, especially in Florida, where the discount accrues to people who live in the highest flood zones, which are closest to the water, which are usually inhabited by more affluent people. So these two effects, activity and distribution, do push for more, you know, for the more actuarially fair premiums. And I guess my antennas kind of shut up when you said, "Oops, slow down," because we might have a counter effect on take-up, which is kind of speculative. So it's just a way to reflect about these policy implications that arise from your study.
Yeah, fair enough. Point taken. I will say though, because we find a demand response, so when the price variation that I exploit, when prices go up, demand falls. If we kind of trace out that that logic all the way through, and we keep raising prices to try to reflect actuarial risk, at the end of the day, if nobody purchases this insurance because we've decided that, you know, the actuarially fair price is $12,000 or something, and everybody opts out, we can continue to change the price. But if it's a good that at the end of the day, very few people purchase, they aren't getting that price signal. And so in order to actually make that price signal salient, if people don't think it's something that they actually need, we would need some other policy, such as a mandate. So we charge them whatever the actuarially fair price is, and then we encourage them to purchase it. And that's where we would potentially get the benefits along the line that you described, right? So if you're gonna live in a high-risk flood zone, you're gonna have to pay the full social cost of living there, and that includes, you know, whatever the flood insurance, the cost of the National Flood Insurance Program would be from insuring you. And the issue with just relying on, with I guess just changing prices, is that at the end of the day, if we don't have this other type of policy, we could just end up in a world where nobody buys it and then there's no useful signal. So I completely agree that we want to accurately provide that signal to encourage these other activities to reach the socially efficient level. There's just a question of exactly how we do that. For your second point for equity, also fair point taken. I think a lot of these houses that are insured also are, this is like the coastline of Miami-Dade. We're insuring, you know, these beachfront properties. And so while there will be overall distributional implications, some people may actually be benefiting from a transfer when maybe they don't necessarily need it. So it probably goes both ways.
Can I ask about the I guess about this slide? And in your paper, you say, this is footnote 38, that a mandate doesn't require information on the precise form of behavioral friction, so it kind of doesn't matter what's really causing it. You run through, and very carefully, you didn't have time to get to all those, but you run through very convincingly, like, well, it's not that people think they're going to get bailed out anyway, so that just crowds out their demand. All the other stuff, you have very plausible things to say about what's what's not driving it. So maybe as a technical matter, you're right that we don't have to know that there's a distortion. As long as we know what it is, we can sort of design policy around it. But it seems like in crafting the policy, you would want to know what it is. If it's people don't believe the government, then it's not going to do any good for FEMA or whoever to say, hey, there's really a big risk. Climate change is real. That's just going to lead people to go to the internet and start looking at QAnon stuff. If they don't trust the government, maybe a mandate's not the right way to go. Instead, we should just say that it's bundled automatically with your homeowners policy and force homeowners insurance to cover it. So like it seems like the mechanism is going to be hard, and I know your data don't really allow you to say much about that, but I just think you were a little bit cavalier about saying, well, we don't really need to know what's causing it, as long as we know that people are just somehow wrongly, stupidly, irrationally not valuing insurance enough. But don't you think? Yeah, okay, so never mind.
No, I was going to say, well, I think there's a lot more work to be done in this space, right? So we don't necessarily have a good handle on the extent to which all of these different types of behavioral distortions could be contributing to low uptake. I'm pointing here to risk misperception, which there is some evidence in the literature that homeowners seem to underestimate their flood risk just based on surveys that have been done. But if anybody else wants to go and explore, inertia or some of these other explanations, I think that would be very worthwhile. What I mean with that footnote is that if all of these distortions push in the same direction, so suppose you're, mistrustful of a government program, or you underestimate your risk, or, flood insurance isn't a good you've ever purchased in the past, and you just keep going with that behavior, a mandate would address low uptake created by all of those. And so, if we think that really we want to correct this perplexingly low willingness to pay, we don't need to really know exactly why willingness to pay is lower than we might expect. If we want to achieve that welfare gain, a mandate acts as kind of a blanket that would yield the same welfare effect regardless of the plausible explanation. So we could think of other policies, right? Maybe if risk misperception really is the lion's share of the wedge, then having an information policy would be really important. But in order for that information policy to have the same effect as the mandate, we really need to know its risk misperception. And I think you're right that we don't know that at this point. And so that's why I kind of mentioned the mandate instead of information-based policies, because information-based policies are going to require more information than I think we have now, if that makes sense.
Yeah, fair enough. On the other hand, we already have a mandate, and it seems to be an ignored mandate. So like when you start to think about the political economy, then like everything is up for grabs, including whether we have rules and whether the rules that we have are enforced. And so, God,
absolutely. But the flip side of that is it does make it potentially easier to have a mandate. We just enforce the existing one. We don't actually have to push a mandate through any kind of level of government because it's already there. It's just we aren't enforcing it for whatever reason. And I think now, as I mentioned, like in the last few years, my data finishes in 2017, but even more recently than that, I think there is increasing realization that, there's this policy in place and we haven't enforced it. And now the costs and the amount of money that are at stake are just so high that we are actually starting to think about enforcing it a little bit more, as far as I can tell.
Great. Okay. Well, we have maybe time for one more. Travis, do you want to come in?
Sure.
Yeah, I'm happy to stick around. Sorry, Travis.
Oh, thank you.
I'm
Wonderful.
happy to stick around for an extra 10, 15 minutes. I know I went maybe a little bit long with the 40 minutes I was given. So.
Great.
I mean, so this might take you into the next paper you plan to write, but I wonder whether there are other correlates that you have in mind, that you'd like to test for in terms of, because I assume there's regional variation, at least with regard to the willingness to pay. And so like, could you create a heat map and show where there's a really unusual aberration in one direction or the other, and then try to use that to guide your intuitions, or what would you see?
Yeah, that's a great thought. So I don't have distributional graph of or map of willingness to pay in this paper, but I think that starts to lead us down this path of equity, which I think it was Omri had mentioned. So looking at, why is willingness to pay lower for some folks than others? Is there any kind of income story here? If we have differences in willingness to pay, then if we change prices differentially for different areas, are we going to create disproportionate costs for some subgroups of society? And that is a road that I'm starting down, but I don't have any useful conclusions to share with you yet. But also I think is, super, super important to think about who is going to bear most of the benefits and costs from this policy.
I mean it less from the normative side and more from just the, the model side. Like if there's a region that was hit by a bad hurricane a year ago, are they now more willing to pay than their neighbors?
They are, but that's a paper that's been written and unfortunately not by me.
Okay, great.
And so I'm happy to point you in that direction, but there's other work that shows the day after a flood, there's this kind of spike in uptake. We can have a conversation about if that actually overshoots the efficient willingness to pay just because of the salience. And so then after that point, there's a spike in uptake, and then at a certain point, it starts to decline back down. So this could be either homeowners are moving, they're taking the knowledge of their flood history with them after 5-10 years, or they just start forgetting the salience of that flood event is now several years in the past.
You could imagine a bunch of other things like political orientations or like vacation homes, like regions where people are actually their tax residency somewhere else. They probably like to be in Florida, I imagine. But anyway, like if it's a vacation home, maybe you just let it go. And I imagine a bunch of other things you could test for that'd be very interesting to see.
Yeah, absolutely. Lots of interesting questions here.
Anybody else want to jump in? I can't see everybody's hand, and no one has chatted to me.
Peter.
Oh, Sonia.
Hi.
Okay, please.
Hi. I just point of clarification. Under the new risk rating 2.0, flood zones are less important when it comes to rating property now. When you look at the variables there, they're looking at construction cost, number of floors on a home. The building description is critical. How is the building built in terms of new flood requirements, elevation, numbers of residents in, or I should say, if it's a condo building versus a single family dwelling. So when you look at risk rating 2.0 versus your paper, which may have been based on the old flood underwriting requirements, entirely different. Plus the pricing is so different. I mean, I just looked and worked with a consumer under risk rating 2.0, a California consumer in an area that had never flooded, is a participating town. And the policy was rated at $4,000 with $20,000 deductible, which is $10,000 per coverage or per peril, excuse me. And on a fully paid off house for 2 retirees, they didn't want to spend that kind of money when their earthquake policy was less than $1,000 a year, and they felt their exposure to earthquake was far greater than flood. So from a take-up perspective, in their mind, it didn't make sense to buy a flood policy when they could invest $4,000 a year and get the investment income. And if they needed to take out a mortgage because of a loss later on, they could.
Fair
So
enough.
I think when people look at the economics of buying a flood policy, especially now versus, the past, a lot of people are saying it doesn't make sense with those types of deductibles and cost.
Yeah, and that, I guess there's a question of whether it truly doesn't make sense, or if there is important underlying risk and it would actually be worthwhile. Now, risk rating 2.0 is intended to be the modernization of the risk models and prices. And so the goal with those prices is to actually better reflect the underlying costs of insuring a particular home. And so that would lessen the potential for adverse selection because now we're pricing more variables. So there's less room left for homeowners to have private information, even though under the Corsair model, there seems to be relatively limited evidence of that. But there's still a question of if homeowners think it isn't worthwhile because it truly isn't worthwhile, or if they just don't know what their risk actually is. And there are also now, there's a push to provide more public information about your flood risk. So you can go online. First Street Foundation, you might be familiar with it. They have a really nice website. You can put in a residential address, look up what your individual flood risk is. And so you could collect some information from an independent source and maybe make more informed decisions.
Right, and I did that with them, and
Yeah.
they were two economists who said this doesn't make any sense to us. But thank you.
Well, maybe this, yeah, maybe this is evidence of these risk misperceptions, or what do you think?
Well, as an insurance person and as a flood expert, I said to myself, it's better to put your money in earthquake than in flood.
Fair enough.
On that happy note, maybe if there's nobody else, we can just join together in thanking Katherine for that really stimulating, interesting talk. Come back again with your next paper as we follow up on all the interesting things you have left to do.
I would
And
be
thank you
happy
again.
to. Yeah,
Okay.
thank you so much for inviting me. It's been really great chatting with you, and
Cool.
hopefully see you again. Take care.
Excellent. Thanks a lot.
Bye-bye.
Bye, everybody. See you in 2 weeks.